Hi friends, this is CS Sai Akash. So let us continue with the revision series of CA Intermediate FM. So today we'll be revising extremely easy chapter but yet scoring chapter, that is your dividend decision. As you're aware, FM is a function of three decisions: financing decision, investment decision and dividend decision. So we'll discuss dividend decision. Even before we step into the core content, let us revise some basic formulas. So to start with, dividend per share. So what do you mean by DPS? Dividend per share is determined by the formula face value into rate of dividend. So whenever we say the company has declared dividend, 5% dividend, 10% dividend, 15% dividend, dividend is always as a percentage of face value. Remember, dividend is always as a percentage of face value. So what is the formula for DPS, dividend per share? It is face value into rate of dividend. Coming to dividend payout ratio. Next formula is dividend payout ratio. Payout is always as a percentage of earnings. Remember, payout is always as a percentage of earnings. So what is the formula? Dividend per share divided by earnings per share. So what is the formula for dividend payout ratio? Dividend per share divided by earnings per share into 100. Then what do you mean by retention ratio? Retention ratio means out of my total earnings, whatever I have paid it out as dividend, the remaining will be retention. So retention ratio formula 100 minus payout ratio. Coming to next formula, dividend yield ratio. Dividend yield ratio. Always remember, yield is always as a percentage of market price per share. So what is the formula? Dividend yield ratio equal to dividend per share divided by market price per share. Dividend per share divided by market price per share. Now we'll step into the core content dividend chapter. So dividend chapter again, dividend relevance theory, dividend irrelevance theory. If you divide the chapter into two parts, dividend theory, dividend relevance theory, dividend irrelevance theory. Sir, what do you mean by dividend relevance theory? Dividend relevance theory means my market price per equity share is dependent on my dividend decision. I repeat, my market price of the equity share is dependent on my dividend decision. That means it is a dividend relevance theory. In other words, my dividend decision will have an impact on my market price of an equity share. Coming to dividend irrelevance theory. What do you mean by dividend irrelevance theory? Sir, whatever may be your dividend decision, my market price will remain same. So my market price is not affected by the dividend decision. That is called dividend irrelevance theory. Again, we have four theories under dividend relevance theory: Walter's approach, Gordon's approach, Graham and Dodd's approach, and Linder's approach. Coming to dividend irrelevance theory, there is only one person, very important, that is M&M, Modigliani and Miller. We'll start with one by one. First one is Walter's approach. Exam point of view, Walter is important. Exam point of view, Walter is important. So what is the formula given by Walter? The formula is P equal to D plus E minus D into RA by RC, the whole divided by RC. First understand the formula. What are we calculating? P. In the left hand side, P. P equal to D plus. Remember, brackets are important. D plus. So D is outside plus. What you have to do? E minus D. E minus D. What is E minus D? If you see E minus D, earning minus dividend is nothing but retention. Retention into RA divided by RC, the whole divided by RC. Now, if you ask me, what are these notations? P means market price per share. D means dividend per share. E means earnings per share. E minus D is nothing but retention. What is RA? RA is nothing but ROI, the return generated by the company, the return on investment or the return on capital employed generated by the company, ROI. So it is a return earned by the company. RC means capitalization rate. KE, also known as investors expectation, also known as discount rate. There are multiple terms. So what is the formula? What does Walter say? Walter says your market price is dependent on your dividend decision, and he gives a formula to calculate market price per share. So how do you calculate market price per share as per Walter? It is P equal to D plus. D means dividend plus E minus D. E minus D is nothing but what? Retention divided by RA. RA means rate of return earned by the company divided by RC. RC is the opportunity cost. The whole divided by stress, the whole divided by RC. Yes. So this is the formula given by Walter. You apply this formula, you get the market price per share. I'm not explaining the concepts now because it is a revision class. I'm only explaining the formula. Yes. Yes. So what is the suggestion given by Walter? Sir, what is the suggestion given by Walter? Walter says if your RA is more than RC, in other words, your company is earning more returns as compared to the market. See what happens when I pay dividend as an investor. What is the ultimate objective of financial management? It is maximization of shareholders' wealth. So whenever a company pays dividend as an investor, what will I do? I'll go and invest it in somewhere else, say in the share market. So what is the suggestion given by Walter? You compare two things. One, what is the rate of return generated by your company, and also compare the rate of return generated by the market. That is nothing but your opportunity cost. What is your ultimate objective? Your ultimate objective is maximization of shareholders wealth, equity shareholders wealth. So where will my wealth grow? If my company is earning more than the market, say for example, company is earning 20% and market return, average return is 15%. So in that case, what is the suggestion given? 100% retention. So you should not give any dividend. Why? If I give dividend, what will the shareholder do? He'll go and invest it in the market. My company is earning 20%, market is only earning 15%. Where will his money grow? The money will grow more in my place. Correct? In that case, I should not give any dividend. 100% I need to retain. Why? The shareholders wealth is being maximized where? In the company or market? Then the answer is in the company, because I'm earning 20%, market is only giving 15%. Now the other way around. What if my company is earning only 15% return, whereas market is earning 20% return? So in that case, Walter says, boss, when your equity shareholder has an opportunity cost where he can earn 20%, your company is only earning him a return of 15%. In that case, you don't keep his money, give entire money as dividend. In that case, 100% you need to pay it out as a dividend, and you should have zero retention. Why? Because he'll invest it in 20% return. Your company is only giving him 15%. So when will the ultimate objective of maximization of equity shareholders be maximum? When the return earned by the equity shareholder is maximum. Yes. What if me and market, I am also earning 15%, market is also earning 15%. In that case, your price per share will be the same. Whether you give dividend, you don't give dividend, it will be the same. So again, to sum up, what is the calculation? How do you calculate market price per share as per Walter? Formula is P equal to D plus E minus D into RA by RC, the whole divided by RC. Yes. What is the suggestion? Suggestion is, if the company is generating more returns, then you have to pay zero dividend. Everything should be retained by the company. If the company is earning less than the market rate of return, then you have to pay 100% dividend, zero retention. If you and the opportunity cost and the market, if the company and the market both are giving you similar returns, in that case your P will remain same. So this was all about Walter. Coming to next one, Gordon. Again, Gordon is a dividend relevance theory. If you see, Gordon's approach is approximately similar to your TP plus G approach in your cost of capital, cost of equity. What is the formula given by Gordon? Gordon gives PO equal to D1 divided by K minus G. What is the formula? P0. P0 equal to D1 divided by K minus G. What is P0? P0 is your market price per share. What is KE? KE is your cost of equity. KE is your cost of equity. What is D1? D1 is next expected dividend. So how do you calculate D1? Very simple. D0 plus growth. D0 plus growth. What do you mean by G? G means P into R. The same growth. P into R. Retention ratio into ROI. Retention ratio into ROI. So what is the formula given by Gordon? Gordon says your market price per share today is nothing but the present value of all your future dividends. The market price per share today is nothing but the present value of all your future dividends. So what is the formula? P0 equal to D1 divided by KE minus G, wherein P0 is equal to market price per share, D1 is dividend, next expected dividend, KE is your opportunity cost, that is nothing but your cost of equity, and G is nothing but growth rate. Growth rate means G into B into R, G equal to B into R. Again, what was the suggestion given by Gordon? Same as Walter. Whatever was the suggestion given by Walter, the same suggestion has been given by Gordon as well. So if RA is greater than RC, 0% payout, 100% retention. If the company is earning more, market is earning less, 0% payout. Everything, all the money should be in the form of retention with the company. If the other ways, in the other case where the market is earning more, company is earning less, market is earning more, company is earning less, in that case you have to give 100% dividend. The company should not keep any money. If RA is less than RC, 100% payout, 0% dividend. Again, if RA is exactly equal to RC, then P will remain same. Exactly the similar suggestion given by Walter. So exam point of view, Walter and Gordon are important. Exam point of view, either it will be a Walter question or it will be a Gordon question most of the times. Yes. So Walter and Gordon. Coming to the next approach, Gram and Dot. Gram and Dot model is also called as traditional model. Remember the name, traditional model. Again, what is the formula given by him? Formula is P equal to M into D plus E by 3. What is the formula? P equal to M into D plus E by 3. So what is P? P is market price per share, D is dividend per share, E is earning per share. What is this M? M is a multiplier. It is an arbitrary figure given in the question. The derivation of this figure is out of syllabus. So don't worry, M will be given in the question. So how do you calculate? Now, if you try to understand, he is giving 1/3 importance to earnings. Why? He is dividing earnings by 3 and he is giving more importance to D, dividend. So E by 3 plus D, that he will multiply with the multiplier that will be given in the question to calculate market price per share. Again, what is the suggestion given by him? He always suggests, since he is giving more weightage to what? He is giving more weightage to dividend. He is not much interested in earnings. So what is the suggestion given by him? You should always have highest payout ratio. Highest payout ratio, if you have the highest, then market price will be highest. If you have lowest payout ratio, market price per share will be lowest. This was the suggestion given by Graham and Dodd. In other words, it is a traditional approach. Coming one to the last one, Linter's model. Linter's model. One very important difference is in the first three models you are calculating price P. Here it is the only method where I am calculating D1. I am calculating D1, next expected dividend. So how do you calculate D1? D1 equal to D0. D0 means what? D1 means what? Next expected dividend. What is 0? Last paid dividend. Your last paid dividend. So D0 plus EPS into target payout ratio. EPS into target payout ratio minus D0. So D1 equal to D0 plus EPS into target payout ratio minus D0 into AF. Again, what is this AF? It will be one arbitrary adjustment factor given in the question. It will always be less than 100%. It is always less than 100%. So Linter says your next expected dividend should at least be your previous dividend. Your next expected dividend should always at least be the previous declared dividend. And in addition to that, EPS into target payout ratio, that is the incremental dividend. If you see what is this entire bracket, EPS into target payout ratio minus D0 is nothing but the incremental dividend or the marginal dividend. The extra dividend that you are going to give, that he'll multiply with AF, the adjustment factor, and then he'll add D0 to get D1. Yes, this is the only method where I am calculating D1. I am not calculating P0. Yes, these are all dividend relevance model wherein my market price per share is dependent on my dividend decision. In other words, my dividend decision is affected by the market price per share. Coming to one and only M&M, that is dividend irrelevance theory. Dividend irrelevance theory. M&M, again, exam point of view, extremely important. Exam point of view, either you will get Walter or Gordon or M&M. Most likely. It is not that you should ignore Graham and Dodd and Linter. They are also important, but these are more important. What is the formula? P0 equal to P1 plus D1 divided by 1 plus KE. What is the formula? P0 equal to P1 plus D1 divided by 1 plus KE. What is P0? Value of the per share today. What is P1? Value of the share after 1 year. D1 is next expected dividend. K is capitalization rate. What is the formula? P0 equal to P1 plus D1 divided by 1 plus K. What is the application? How do you solve exam problem? Here what is, we'll go by a stepwise approach. It is a statement format answer. We'll go step by step. What is step number 1? You need to calculate value per share at various dividend cases. In the question, either it will be 0 rupees dividend, 10% dividend, 20% dividend or 100% dividend. Various cases will be given. For each of the case, you need to calculate what? Using this formula, you need to calculate P1. So P0 equal to P1 plus D1 divided by 1 plus K. You need to calculate it for P1. Why? Because P0 will already be known in the question, right? Practically P0 is a price today and today's price I already know. What will be the future price that I need to estimate using this formula? And what is your step number 2? Step number 2, it will be a statement format answer. First you need to calculate net income. Net income, again profitability statement, net income. In that you need to pay dividend. So out of income, if you pay something as dividend, whatever it will remain is what? It is your retention. So whatever will remain is your retention. These steps are very simple. Net income minus payout, retention. Then you need to compare that with the total investment required. You need to compare it with the total investment required. It will be given in the question. Then if you do C minus D, total investment required minus the retained earnings that you already have. Total investment required, out of it some portion you already have. That will give you, so fresh issue of equity shares. So total investment required minus retention. It will give you fresh issue of equity shares. Then you will calculate price per share, that is already calculated in step number 1. Then you will find out number of shares to be issued. How do you find out number of shares to be issued? Total fresh issue divided by price per share, that will give you number of shares. Now you will have total number of shares. You will have total number of shares, existing shares plus new issue, that is point number G. With that, you will calculate total value of the company after 1 year. Total value of the company is nothing but total number of shares into market price per share. This is value after 1 year. So it will be a columnar wise approach, no dividend, dividend paid or some dividend paid. So in each of the column, this last step, the total value of the firm should be equal. The total value of the firm should be equal. Yes, I repeat, how do you solve M&M question? Step number 1, you need to calculate P1 using the formula P is 0 equal to P1 plus D1 divided by 1 plus KE. Then in the statement format, you need to start net income dividend payout will give you retention. That retention you need to compare with the total investment required. Total investment required minus retention will give you fresh issue. Fresh issue of equity shares, total amount. That if you divide by price per share that you calculated in step number 1, that will give you total number of fresh shares to be issued. So total number of fresh shares plus existing number of equity shares will give you total number of shares. Total number of shares multiplied by market price per share will give you total value of the company. Total value of the company. Yes, this value of the company will remain same in all the cases. So because it is a dividend irrelevance theory. Yes. So these are all the topics. Since it is a formula oriented chapter, the examiner will not necessarily ask you the left hand side of the formula. Any one of the variable might be asked in the question. So instead of asking P, for example, instead of asking P, examiner may directly give you P and he'll ask you to calculate either D or E or D or RA or RC. Understood? So since these are formula oriented, any of the variables may be asked as a question in the exam, you should be able to answer. Apart from this, there is some theory part in the module, that is what are the factors that is affecting your dividend decision. Please go through. It may come for 2 or 4 months. So immediately after watching this video, please open up your question bank, solve all the questions from this chapter. This is a very scoring chapter. Ensure that you don't lose a single mark from this chapter. Yes, thank you.